Stop, don't cash that check yet. If you are a retiree, a widow, or receiving disability, you need to listen closely because everything just changed. As of this morning, the Social Security Administration has officially flipped the switch on a massive wave of new regulations that will directly impact your bank account. We aren't just talking about the 2.8% COLA increase. There are hidden earnings test triggers and brand new Medicare Part B deductions that could actually shrink your monthly payment if you aren't careful. Are you under full retirement age and still working? You could be hit with a forced benefit withholding of $1 for every $2 you earn over the new $24,480 limit. Plus, for the first time in 2026, a taxation trap is catching millions of seniors who thought their benefits were tax-exempt. This is the official notice the government won't explain in detail, but I'm breaking down the exact math you need to protect your income today. Don't let these rules catch you off guard and leave you with a surprise bill from the IRS. I've analyzed the new One Big Beautiful Bill tax breaks and the updated $184,500 wage cap so you don't have to. This is urgent. Your financial future depends on knowing these numbers. Smash that like button right now to help other retirees see this warning, and let's dive into the 3 things you must do before the end of the day. Gemini said, "Look, I know you've heard a lot of noise about Social Security lately, but today is the day the rubber meets the road. We are officially stepping into a new era of retirement rules that were set in motion decades ago, and if you aren't paying attention to your bank statement this week, you are literally leaving money on the table." The Social Security Administration has just confirmed a massive shift in how they calculate your work-to-benefit ratio. And for the millions of you who are still working part-time or considering a side hustle, the stakes have never been higher. We are talking about the final execution of the 1983 Social Security Amendments. This isn't just some minor adjustment. This is the year the full retirement age hits its ultimate ceiling of 67 for everyone born in 1960 or later. This is a historic milestone that marks the end of an era and the beginning of a much more rigid landscape for your retirement planning. Let's talk about the immediate cash flow impact because that is what matters right now. If you're looking at your calendar for March, you might notice something strange. Because March 1st falls on a Sunday this year, the SSI payment schedule has been pulled forward. If you are an SSI recipient, that money is hitting your account early, specifically on Friday, February 27th. But here is the danger. A lot of people see that extra deposit at the end of February and think the government sent them a bonus or a stimulus check. It is not a bonus. It is your March payment arriving early. If you spend that money like it's extra cash, you are going to find yourself in a massive financial hole when March 15th rolls around and there's no check in the mail. This calendar trap happens every few years. But in 2026, with inflation still biting at the heels of every senior's budget, falling for it could be devastating. But it's not just about when you get paid, it's about how much they are taking back. The new earnings test limits for 2026 are officially in effect as of today. If you are younger than your full retirement age, the SSA is now tracking every penny you earn over $24,480. If you go just $1 over that limit, they are going to claw back $1 for every $2 you earn. Imagine working hard at a part-time job to keep up with rising grocery prices only to realize that the government is effectively taxing you at a 50% rate by withholding your benefits. Now, the limit has gone up slightly from last year, giving you a tiny bit more breathing room, but the special monthly rule is where people get tripped up. If you just retired mid-year, you can still get your full check for any month the SSA considers you retired, regardless of your yearly total, as long as you stay under the $2,040 monthly cap. You have to be a detective with your own finances these days, just to keep what you've earned. And we can't ignore the silent squeeze happening with Medicare Part B. While everyone was celebrating the 2.8% COLA increase that started hitting checks in January, the Centers for Medicare and Medicaid Services dropped a bombshell. The standard Part B premium has jumped to $202.90 per month. That is a nearly 10% increase year over year. For many of you, That premium hike is eating up almost half of your COLA raise before the money even touches your hand. You see a raise on paper, but your actual net deposit might feel exactly the same, or even smaller than it did last year. This is why understanding the no tax on Social Security provisions in the new One Big Beautiful Bill is so critical. There is a new senior deduction that could shield up to $6,000 of your income from federal taxes, potentially giving you a massive refund when you file your 2025 returns this month, but you have to know how to claim it. I'm seeing so many people get blindsided by the taxation trap. Did you know that if your combined income, that's half your Social Security plus your other taxable income, crosses $34,000 as a single filer, up to 85% of your benefits become taxable? With the new 2026 tax brackets now live, some of you might be pushed into a higher tier without even realizing it. The IRS and the SSA are more linked than ever before, and if you haven't adjusted your voluntary withholding, you might find yourself owing thousands of dollars next April. We are living in a time where set it and forget it retirement is dead. You have to be proactive. You have to verify your payment dates, March 11th, 18th, or 25th, depending on your birthday, and you have to audit your Medicare deductions immediately. Beyond the calendar shifts, we have to look at the structural changes that are landing today. For the first time, we are seeing the implementation of the $184,500 wage cap. This means if you are one of those high-achieving seniors still in the workforce or running a successful business, you're going to be paying into the system longer throughout the year than you did in 2025. It's a double-edged sword. You're funding the program, but you're also seeing a smaller take-home pay for more of the calendar year. This is combined with the fact that the value of a single Social Security work credit has risen to $1,890. If you have younger family members trying to qualify for their own future benefits, they have to work harder and earn more just to get the same 4 credits per year that we used to get for much less. The bar is being raised across the board, and if you aren't factoring these numbers into your family's long-term financial plan, you are flying blind. Let's dive deeper into the One Big Beautiful Bill, because this is where the real drama is happening. There's a lot of confusion about whether federal taxes on Social Security have been eliminated entirely. The truth is more nuanced. While the bill introduced a senior bonus deduction, it didn't technically strike the 1984 tax law from the books. Instead, it created a massive $6,000 shield for individuals, $12,000 for couples, that effectively zeroes out the tax bill for roughly 88% of seniors. But here is the catch. It's a temporary provision. If you don't file your 2025 and 2026 taxes correctly using the new forms that the IRS just released this morning, you might miss out on that $6,000 deduction and end up paying a tax that the government technically said you shouldn't have to pay. It's a bureaucratic hurdle that requires your immediate attention. Now, I want to talk to the millions of you receiving disability or survivor benefits because you are facing a specific challenge today. The Substantial Gainful Activity (SGA) limits have shifted. For non-blind individuals, that limit is now $1,790 per month. If you are trying to transition back into the workforce or just trying to make ends meet with a small job, crossing that $1,790 line by even $5 can trigger a full suspension of your benefits. The SSA is using more advanced automated data matching with the IRS than ever before. They are seeing your income in real time. The days of reporting it later and hoping for the best are over. If your income fluctuates, you need to be using the SSA's online portal every single month to avoid a terrifying overpayment notice that could demand you pay back $20,000 or $30,000 in benefits you weren't supposed to receive. And what about the dividend talk we've been hearing? There's been a massive rumor circulating that a special $2,000 tariff dividend is being added to the March checks. Let's clear that up right now. As of today, that proposal is still sitting on the floor of Congress. It is part of a larger legislative package that has not been signed into law. If you see a video or an article telling you that your March 2026 check will have an extra $2,000 stimulus added to it, they are misleading you. The only new money in your check is the 2.8% COLA increase and any tax savings you might see from the senior deduction. Banking on a stimulus that hasn't passed yet is a recipe for disaster. We have to deal with the reality of the numbers as they exist today. The reality today is that the Social Security Trust Fund is under immense pressure. The CBO just updated their projection, moving the depletion date up to the fourth quarter of 2032. Why does that matter to you in March 2026? Because every legislative move, like the increase in the Medicare Part B deductible to $283, is a symptom of a system trying to find balance. They are shifting more of the cost of healthcare onto you to preserve the core retirement fund. This makes your choice of a Medicare Advantage plan or a Medigap policy more important than ever. If you missed the open enrollment period, you might feel stuck, but there are special enrollment periods triggered by these new rules that might allow you to switch to a plan with lower out-of-pocket costs. I also want to touch on the remittance tax that just went live. If you are a retiree who sends money to family overseas, there is a new 1% excise tax on cash-based transfers. It's another small drain on your resources that wasn't there last month. Everything is becoming more expensive, and the government is finding new ways to collect pennies that add up to dollars. This is why you need to be auditing your subscriptions, your insurance premiums, and your utility bills this week. With the March payment schedule being so front-loaded for SSI and potentially delayed for others due to bank processing times, your cash on hand is your only defense against a late fee. Let's look at the calendar one more time because I want to make sure you have these dates burned into your memory. If your birthday is between the 1st and the 10th, mark March 11th. If you're the 11th through the 20th, it's March 18th. And for the rest of you, March 25th. If you receive your benefits because you started before 1997, your date is March 3rd. These are the official notices of payment, but remember that Direct Express cards and certain online banks like Chime or SoFi often release the funds 2 to 3 days early. Do not count on that early release for your rent payment. Banks are dealing with new anti-fraud protocols that were implemented this morning, which could lead to temporary holds on large deposits as they verify the new 2026 payment amounts. It is a lot to take in, but the theme of 2026 is active management. You can no longer be a passive recipient of a government check. You are a manager of a retirement portfolio, and that check is just one part of it. You have to navigate the 2.8% COLA, the 21290 Medicare deduction, the $24,480 earnings limit, and the new $6,000 tax shield. If you feel overwhelmed, you aren't alone. Millions of seniors are waking up today trying to figure out why their check looks different than they expected. The key is to stay calm. Check your My Social Security portal for your specific benefit verification letter, and make sure your withholding is set to a level that won't leave you with a debt to the IRS next year. We are seeing a fundamental shift in the social contract. The full retirement age of 67 is now the law of the land for everyone moving forward. The age of early retirement with full benefits is gone. This makes the delayed retirement credits even more valuable. If you haven't claimed yet, remember that for every year you wait past 67, your benefit grows by 8%. In a world where the COLA is only 2.8% and inflation is higher, that 8% guaranteed growth is the best investment on the planet. If you can afford to wait even for 6 months, the math says you should. The rules are officially live. The payments are moving. The taxes are changing. This March is not just another month. It is a turning point for the American retiree. You have the information, you have the dates, and you have the strategy. Don't let the silent squeeze take your peace of mind. Stay on top of your accounts, watch for those deposits, and remember that in this new economy, knowledge isn't just power, it's your paycheck. Keep a close eye on your mail for the official SSA 1099 forms and the new One Big Beautiful Bill tax guides that are being sent out this week. This is your year to take control of your financial legacy. This new landscape requires a level of precision that we've never seen before. For instance, the Social Security portion of your payroll tax remains at 6.2% on earnings up to that new $184,500 maximum, but the Medicare portion of 1.45% continues with no limit. If you're in that upper income bracket, you're looking at a significant annual contribution. But even for the average worker, the requirement to earn 1/4 of coverage or work credit has jumped to 1,890. This means you need to earn $7,560 over the course of the year to get your full 4 credits. For a young person starting out or a senior working very limited hours, reaching that threshold is more difficult than it was just 12 months ago. It's a subtle tightening of the belt that affects every generation currently in the workforce. When we talk about the SSI federal payment standard, the numbers have moved to $994 for an individual and $1,091 for a couple. This sounds like an improvement, and for many, it is the difference between making rent or not. But remember that SSI resource limits are still frozen at $2,000 for individuals and $3,000 for couples. This is one of the most controversial aspects of the 2026 rules. While the payments go up to match inflation, the amount of money you're allowed to save remains stuck in the 1980s. If you receive an inheritance or a small gift that pushes your bank balance to $2,001, you could lose your entire SSI check and your Medicaid eligibility in an instant. This asset trap is a major concern for 2026, and there are currently no legislative fixes in the immediate pipeline. For those of you on SSDI, the Trial Work Period, TWP, has also seen an adjustment. The monthly earnings threshold to trigger a trial month is now $1,210. This is a critical number. If you earn $1,011, you have used up one of your 9 precious trial months. If you earn $1,209, you haven't. This kind of cliff edge accounting is exactly why you need to be tracking your gross wages, not your take-home pay, every single week. The SSA looks at the money before taxes are taken out. I have seen too many people lose their disability benefits because they calculated based on the money that hit their bank account instead of the money their employer actually paid. Let's look at the One Big Beautiful Bill, OBBBA, impact on your everyday spending. This bill wasn't just about income tax. It actually includes provisions that change how your bank handles your money. There is a new 100% bonus depreciation rule for small businesses that many self-employed retirees can use to write off the cost of new equipment, like a computer or a vehicle used for work, in the first year. If you are doing consulting or gig work in your retirement, this could wipe out your entire tax liability for the year. This is the kind of aggressive tax planning that was once reserved for the wealthy, but the 2026 rules have brought it to the kitchen table of every American senior. The trust fund depletion risk of 2032 is the elephant in the room. When the CBO says the fund could be empty 6 years from now, they are warning that if Congress doesn't act, benefits could be cut by 20% to 25% across the board. This is why the reforms we are seeing today, the higher premiums, the increased work requirements, the higher wage caps, are being pushed so hard. They are trying to build a bridge to a permanent solution. For you, the individual, this means you need a Social Security defense plan. You need to know exactly what your break-even age is. If you take benefits at 62, you get more checks but smaller ones. If you wait until 70, you get much larger checks but fewer of them. In 2026, with the new life expectancy tables being used by the SSA, the break-even point has shifted slightly toward age 82. If you think you'll live past 82, waiting is almost always the better financial move. We also have to consider the direct primary care, DPC, changes. Starting January 1st of this year, if you are enrolled in a DPC arrangement, you can now use your HSA funds to pay those monthly fees tax-free. This is a huge win for seniors who want more personalized health care and shorter wait times. It allows you to bypass the traditional insurance bureaucracy for your day-to-day doctor visits while keeping your Medicare coverage for major emergencies. This is a brand new retirement health hack that just became legal, and very few people are talking about it yet. As we navigate this March 2026 transition, remember that the most powerful tool you have is your My Social Security account. The SSA has upgraded the security on these accounts this morning, requiring a more robust login.gov or ID.me verification. It's a bit of a headache to set up, but it is the only way to ensure that hackers aren't diverting your direct deposit to a fraudulent account. With the new payment rumors swirling, scammers are working overtime. If you get a call from someone claiming to be from the SSA asking for your bank details to process your March increase, hang up immediately. The SSA already has your info, and they will never ask for it over the phone. The world of retirement is getting more complex, but that also means there are more opportunities for those who are informed. From the $6,000 senior tax deduction to the new DPC rules and the adjusted earnings limits, the 2026 playbook is full of ways to maximize your income. You've worked hard for these benefits. You've paid into the system for decades. Now is the time to make sure the system works for you. Stay vigilant, watch those deposit dates, and keep your eye on the legislation as it moves through Washington. We are in this together, and by staying ahead of the curve, you can turn these new rules into your own financial success story. The official notice has been served. The landscape has changed, but you are ready. You have the dates, you have the numbers, and you have the plan. Now go check those accounts and make sure every dollar that belongs to you is right where it should be. The future of your retirement starts today. Don't let the calendar shifts or the fine print catch you off guard. You are the CEO of your own life, and in 2026, the CEO stays informed. Keep pushing, keep planning, and keep your financial house in order. We've covered a lot today, and the most important thing you can do now is take that first step. Log in, verify, and breathe easy knowing you're in control.